Warren Buffett just made the most shocking housing market move in decades, completely dumping his entire D.R. Horton position while doubling down on Lennar, the Oracle of Omaha, who famously said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Just violated his own golden rule by completely exiting D.R. Horton after holding it for less than a year. Berkshire Hathaway's Q3 2023 13F filing, disclosed on November 14th, revealed that Warren Buffett sold all 1.485 million shares of D.R. Horton worth about $191.5 million, while increasing his Lennar position to 7.232 million shares worth over $910 million. This isn't just portfolio rebalancing. This is Warren Buffett sending a crystal clear signal about which homebuilder will survive what's coming next. But here's what the mainstream media won't tell you about the housing market carnage happening right now. Builder confidence has been stuck in negative territory for 16 straight months. New home sales in July ran at just 652,000 annual rate, flat to down 8.2% year over year, and new single-family inventory has climbed to 499,000 homes with months supply stuck above 9, well above the balanced 6-month mark. We're not just seeing warning signs anymore. We're watching the housing market foundation crack in real time. Let me break down the devastating statistics that most home buyers and investors are completely ignoring. Existing home sales fell to their lowest level since October 2010 in August, while new home sales dropped to just 716,000 annual pace. That's not a soft landing. That's a housing market in free fall. But it gets worse. From the all-time inventory bottom of just 240,000 homes in 2022, we've now climbed to over 1.97 million active listings by late 2025. That's a massive increase in available inventory. And guess what happens when supply explodes while demand collapses? Prices crash. NAR's chief economist Lawrence Yun recently warned that on a nationwide basis, we may have a single-digit price decline. That's quite possible. When the National Association of Realtors, the organization whose job it is to promote real estate, starts talking about price declines, you know we're in serious trouble. Here's the shocking reality. Berkshire Hathaway had purchased D.R. Horton shares in the second quarter of 2025, only to completely exit the position just 1 quarter later in Q3. This represents one of the fastest turnarounds in Buffett's investing history, a clear sign that conditions deteriorated faster than even the Oracle of Omaha anticipated. In a Q3 2025 market showing flat pace, rising inventory, and weak builder confidence, Berkshire has made a surgical decision about which operator can earn its way through a harder, longer, incentive-heavy cycle. Translation: Buffett sees a housing market recession coming, and he's positioning for survival, not growth. This move reveals Buffett's insider knowledge about what's coming next. Berkshire favors Lennar's land optionality, disciplined incentive use, and systems-driven execution, a signal to investors, lenders, and builders about who's best positioned for the next 24 to 36 months of risk, rate pressure, and affordability stress. Think about what this means. Around 37 to 38% of builders are cutting prices, with 2/3 using incentives, typically at 5% or more of home value. When nearly 40% of home builders are slashing prices and the majority are offering bribes just to move inventory, that's not a healthy market. That's desperation selling. Lennar moved early and decisively on incentives, with the company acknowledging that its total incentive load had climbed to more than 13% of home value in some communities, more than double pre-COVID normal. The fact that Buffett views giving away 13% of a home's value as the disciplined approach tells you everything about how bad this market has become. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Here's the demographic time bomb nobody wants to discuss. Millennials, who should be driving housing demand, are getting absolutely crushed by affordability. First-time homebuyers made up just 28% of sales, down from historic norms above 40%. When an entire generation is priced out of home ownership, Who exactly is going to buy these overpriced homes? According to Zillow's analysis, the U.S. housing shortage has reached an all-time high of 4.7 million units. But here's the crucial detail the housing bulls are missing. A shortage doesn't matter if buyers can't afford to purchase. It's like having a shortage of $500,000 Ferraris. Irrelevant if consumers only have $30,000 to spend. The Federal Reserve's interest rate policy has created the perfect storm for housing market devastation. Mortgage rates declined to two-year lows in September, yet total home sales still declined 2.9%. When even dramatically lower rates can't stimulate buying activity, you know affordability has reached a breaking point. Mortgage rates have fallen further to near 6.2%, but mortgage purchase applications have headed consistently lower for 4 straight weeks ending October 17th. Lower rates should equal more applications. The fact that we're seeing the opposite proves demand destruction is accelerating. Here's another terrifying data point. Berkshire Hathaway now holds a record $382 billion in cash, far more than the $267 billion invested in stocks, and has been a net seller of stocks for 12 straight quarters. Warren Buffett doesn't hoard cash unless he sees massive opportunities coming from economic distress. His cash pile is now larger than the entire GDP of many countries. The regional data reveals where the cracks are appearing first. Florida's housing market shows condo and townhouse inventory at an 8.2-month supply, firmly in buyer's market territory, while single-family homes sit at 4.7-month supply. Florida, which was ground zero for pandemic housing mania, is now leading the correction. Florida recorded the largest increase in housing inventory over the past year, with a nearly 35% surge, while Nevada saw a 19.2% decline, showing the stark regional disparities in market conditions. When inventory surges that dramatically in a previously hot market, prices inevitably follow. If you're thinking about buying a home right now, Warren Buffett just gave you a masterclass in market timing. The world's most successful investor made a judgment about which operator's playbook best fits the next 24 to 36 months of risk, rate pressure, and affordability stress. The most positive development has been the increase in active housing inventory throughout 2024, moving the market away from the savagely unhealthy housing inventory conditions of recent years. But for buyers, this is just the beginning. More inventory means more negotiating power, but it also signals that prices have much further to fall. Smart buyers should wait. With builder confidence at 16-month lows, inventory surging, and even the Oracle of Omaha dumping homebuilder stocks after just one quarter, the data screams that better deals are coming. Don't catch a falling knife in today's market. For real estate investors, Buffett's lightning-fast exit provides a crucial roadmap. Buffett and the team he trusts just told you, in the most explicit language he speaks, capital allocation, who he thinks has the answers for surviving this cycle. If you're going to play the home builder space, Lennar appears positioned to survive while others struggle. But the broader message is clear. Defensive positioning beats aggressive expansion in the current environment. For everyone else, public or private, Buffett's move is less about stock picking and more about standards. Can you manage pace and price without losing the room? Can you keep your systems tight enough that investors and lenders know what they're going to get from you, even when the macro doesn't cooperate? Here's a factor most analysts are overlooking. The government shutdown was causing FHA and VA loans to operate with skeleton crews, slowing processing times, while USDA loans weren't being processed at all. When government-backed loans, which represent nearly 25% of the market, face processing delays, it creates additional demand destruction. This is particularly devastating for first-time buyers who rely heavily on FHA loans. With their primary financing source compromised, an already struggling buyer pool shrinks even further. Remember, this is the same Warren Buffett who avoided tech stocks during the dot-com bubble and loaded up on financial stocks after the 2008 crash. His housing market timing has been impeccable, but this D.R. Horton move represents something different: panic selling disguised as strategic positioning. While headlines focused on Berkshire's $4+ billion new position in Google parent Alphabet, the quiet exit from D.R. Horton reveals Buffett's true market sentiment. He's betting on tech's future while abandoning housing's present. That should terrify anyone bullish on real estate. Warren Buffett doesn't make panicked moves, but his lightning-fast D.R. Horton exit after just one quarter represents exactly that. His surgical repositioning from D.R. Horton to Lennar shows he believes this housing cycle requires superior operational discipline to survive what's coming. The market isn't collapsing, it's soft, incentive-heavy, and unforgiving of error, but that soft market is about to get much harder. When builders are giving away 13% of home values in incentives and Buffett is hoarding $382 billion in cash, you know what's coming. For homebuyers, this is your signal to wait for better prices. For investors, this is your warning to prioritize survival over growth. And for anyone still believing in the housing shortage will save prices narrative, Warren Buffett just told you exactly what he thinks about that theory by dumping D.R. Horton after 90 days. The housing market crash isn't coming. According to the Oracle of Omaha's latest portfolio moves disclosed this November, it's already here. The only question now is how deep it goes and who survives the fallout. Based on Berkshire's positioning, smart money is betting that very few builders will emerge unscathed. If you found this video interesting, please subscribe, share, and watch this one as well.